Joining us now with more insight on Disney's numbers is Michael Nathanson. He's the founding partner and senior research analyst at MoffettNathanson. It's good to see you this morning. Welcome.
Good morning. Thanks.
I don't know how you can look at this quarter and be anything other than impressed. They actually knocked the cover off the ball, yet you're reiterating your neutral rating and your $185 price target on the stock. Why?
Because the real valuation driver is Disney Plus, and under the numbers, you see a real slowing down of Disney Plus growth in developed markets, right? And that, the parks recovery we think 2022 profits will equal 2019 profits in the U.S., clear as day. But the real question on valuation to me is Disney Plus, and growth has slowed down outside of India the past couple of quarters, and it feels to us like the products hit maturity pretty quickly, and that is, to us, the big driver of valuation is Disney Plus.
All right, so this is simply, it sounds to me like an issue about the company being able to sustain a more premium multiple.
Exactly. That's exactly it, Andrew.
It's Scott, by the way.
He's better than me, so no. Scott's way better than I am, so take it for what it is.
All that said, judging from your comments overnight to our producers and from your note, you were incredibly impressed by the theme park performance, which you think can, as you say, boomerang higher in subsequent quarters.
Oh, without a doubt. What you're seeing is whoever's going to the parks are paying premium rates, right? Disney does not have to discount any rooms, any park tickets, any food. People who are going there are happy to pay whatever the asking price is. At the same time, the company has restaffed and rethought its cost buckets. So you're getting incredible operating leverage. And from this point on, as I said in the call, what you will see on the profit margin side will be incredibly high incremental profit margins, right? So every dollar coming into the park now will translate to, let's call it 50 to 60% profit, right? So the boomerang is going to happen. And we've never had doubts about Disney's parks. We've been Disney bulls all throughout until the past year or so. But Disney has proven time and time again that they get premium rates and customers are willing and happy to pay it. And that's what's happening through this pandemic. You could see even the occupancy is down to only 50% in their hotels, but the per cap spending is off the charts, right? So that story is as good as there is right now in the business.
Lastly, before I let you run, you do say that DTC losses are likely to have peaked. The sub ads for Plus beat your own forecasts. So how do you factor all that into consideration when coming up with your overall view?
Well, the subs came in better, but if you look again under the hood of what's happening, the subs are growing in India. And do you know what the Indian ARPU is right now?
I don't.
50 cents a month. So you're getting beat by very low valued customers, right? If you go and do the math and peel out the non-Indian subscribers, you're seeing a real slowdown, as is happening at Netflix, right? So again, the optics of this quarter look amazing, but on the Disney Plus side, if you do the work and get under the hood, you'll see that there's a real slowing of growth.